So this is the third of three. This one's only going to go 3 hours. All right. A lot of great questions, both online and here in person. And again, Dan and I and everybody at OIC appreciates you taking the time to come out, joining us online. And we feel very fortunate to be part of OIC, honestly. You know, the industry and its thought leadership to get out here and, you know, help investors, you know, is just a win-win. So thanks to everybody. Let's see, two quick comments. Again, I mentioned as we were wrapping up the last round, we have a new website. We'd love your feedback. So either hit the chat box if you're online or stop by, talk to Alex or Lindsay afterwards. And then also, as far as your online questions, I know we got a ton of them in that last session. Our good buddy Ed Model is behind the scenes. For those of you online, he'll be getting answers to those questions back to you soon. So round three, we're going to roll into the collar. And Dan started with the covered call. And you'll see this is a natural progression. The idea today was, you know, to kind of start with the income, roll it into that whole idea again, getting back to core concepts. Spreads, and now we're going to roll into the collar, which essentially is a spread, and it's comprised of, you'll see, Dan's covered call and then the protective put. So those who may just be joining for the first time out of three, you missed 2 good sessions, but you know, what's important is that options aren't for everybody, as our disclaimer states. And you can get the options disclaimer document either through the OCC or your broker. And, of course, options involve risk. We are actually, the slide says 25 years. I think we've just rolled into our 26th year. And as I may have mentioned before, it was the '87 crash. We remember how much the market was down? October 19th, 1987?
22%.
Yeah. I thought it was 23%, but the difference, how many points? Think about the market now, 23%, 22%. You know, it was 508 points, 508. Didn't we move like 508 points 7 times last week? You know, so things are relative, but it was 23%. And again, leaders in the industry felt we got to get out and it's good. Think about our current bull market. You know, March will be what anniversary? How many years? This coming March? 10 years. 10-year bull market. How many of you, we're not going to talk about it today. I know you said, you know, this might be a good idea, but at least for another session. How many of you have sold cash secured puts in the last 10 years? Okay? Sold puts in the last 10 years. Okay, quite a few of you. Going back to October 19th, 1987, and the market then, that was a 5-year bull market. We bottomed in August of '82. And, you know, the market topped in October of '87, and then we, bam, 23% overnight. There were, believe me, I was on the floor. There were a lot of cash-secured puts where, you know, you sell the put, stock's at 50, maybe you sell the 45 put, and you think you're going to buy the stock at a discount. Well, literally, Tuesday, stock I was trading, MCA Music Corp of America, damn, stock was 31.
Yeah.
What was the value of those puts? How about 19?
When you say cash secured,
you put up the money. Cash secured is where, if you're selling the 45 put, you put up the $4,500 minus the credit you take in.
you only had to put up 2%.
Well, that's on margin. But the point is risk management. Risk management. I make so many presentations, and I got the smiley faces. You know, people have been selling cash secured puts for 10 years. I'm not saying Armageddon's coming. I'm not suggesting it. But, you know, just be aware of the risk. Be aware of the risk.
Ralph Akinford thinks that this market, the bear market's going to be even worse than what we said. So
we have the peanut gallery. I'm just kidding, sir. But You know, there are various opinions out there that maybe, you know, the next bear market is going to be a nasty one. Hey, that's the beauty of the market. You know, we go up, we go down, and we're almost 10-year happy anniversary. But this presentation will focus on collars. And collars are about risk management. As you've heard, these are 5 parent companies. Dan, of course, is part of the NASDAQ. And one detail I didn't mention in the last presentation when I was talking about volume, I mentioned the ISE, which was the first electronic exchange founded in '99. And notice, volume started to take off after you could hit a button and get an execution. Dan's NASDAQ group bought the ISE about 2 years ago, something like that. So that is part of the old ISE, is part of, you know, the NASDAQ group at this point. Again, option volume, probably my favorite slide, because you've got this industry that didn't exist, and now we're just rip-roaring. And I didn't mention last time that spike in volume in 2011. We did 4.6 billion contracts that year. August of that year, up until this past October, was the busiest option month in history. We did over 500 million contracts that month, and we exceeded that this October as well. But it was that spike in volume that took us to 4.6. As I did mention earlier, this year it's very likely that we'll exceed 5 billion contracts for the year for the first time, which equates to about 20 million contracts a day, which is a significant percentage increase over the last couple of years. So options is defense, risk management. Dan's favorite, covered calls. I'll talk protective puts a little bit. I'm going to roll it back to Dan to bring this thing together, and then we'll talk what ifs. So, you know, good defense is really important. Ideally, you don't want to buy insurance, as the adage goes, when your house is on fire. It may cost a little bit. Clearly, we're aware of the volatility in the market, and the one product out there that measures volatility in the S&P 500 is the VIX. Some of you may know. You know, if I go back here, you know, where there was not a lot of historic volatility in the marketplace, that VIX measurement, the expected amount of movement in the S&P 500 over the next 30 days, was in the low teens, that measure. The VIX now is, I think, in the mid-20s and maybe spiking a little higher. And so what that means is that options cost more money. When premiums are higher, and typically it doesn't necessarily funnel down to every option, but generally, when there's more volatility in the marketplace, your calls and your puts cost more. Premiums expand. If you're generating income with covered calls, you're going to generate more income. If you're looking to buy protection like the protective put, your insurance is going to cost you a lot more. So we'll do a quick little review of the covered call strategy. The core concepts there. You're long 100 shares of stock and short a call. Our slide suggests an out-of-the-money call with the collar. Most typically, it's an out-of-the-money call, but not always. It could be an at-the-money, sometimes even in the money. But bottom line is, for every 100 shares of stock you're long, you can sell a call. Motivation with the covered call, of course, is to increase our returns. If we're doing the covered call strategy, typically our forecast is neutral to modestly bullish. If we're more bearish, then chances are you might consider selling an in-the-money call, because that in-the-money call will have more value. Remember, as Dan pointed out, your protection in the covered call, you buy the stock at X price, and then your protection is the amount of premium you take in with the call. So if you sell a $6 call, one of Dan's examples had a $4 premium. You know, if you sell a $4 call, you got $4 of downside protection. You sell an $8 call, you got $8. You sell a $1 call, you've only got $1 worth of protection. That's one of those concepts, easy to understand. You go into the calculators to see what that return can be. But generally, neutral to modestly bullish, because the risk in the covered call is what? What's the risk in the covered call? Stock, exactly. The stock heading south more than the credit you took in for the sale of that call. So that's why generally when we talk covered calls, we're thinking for the most part neutral to modestly bullish. As we say, the risk is in the long stock. The reward will be that maybe the difference between your stock price strike and the premium you take in. And then assignment can be a factor. You'll always want to, be in contact with your tax consultant to see whether assignment makes sense for you. But when you sell options, whether it's a call or a put, you take on an obligation. And when we sell the calls, that obligation is potentially to sell the stock. Back to that same example that Dan talked about. We'll keep it easy. XYZ trading at $52. We're neutral to moderately bullish. We want to generate income. We sell that 90-day 55 call. We take in $175. That's a good picture of you, Dan.
I like it.
Yeah.
Yes. Thank you very much.
So own the stock at 52. Sell that 55 call. Is that 55 call in or out of the money? Out with confidence? Out with $3 out of the money, right? $3 out of the money. Yep. So here we are. And again, thinking about your option positions in your head, like that blue line, as you mature in your knowledge, is a good thing. So as Dan pointed out, when you do a covered call, you're taking on the obligation to sell the stock at the strike plus the premium you paid. So our maximum profit in the example is the difference between 52 and the strike, $300 potential profit potential, plus the 175 that we take in, so 475 total. And you can see that blue line goes sideways. The dotted line represents the value of the stock. Very simple, one-dimensional. You're making money to the upside, losing money to the downside. It's frankly why I love options so much. They have so many different dimensions. And in this example, that one dimension and then obligation gives us an out point. That's why that blue line goes horizontal. And in essence, that your exit price is going to be the strike plus the 175. So we own stock at 52, and in essence, if the stock goes out above the strike, we've sold the stock at what price? I'm hearing $53.75. I don't like that. We own the stock 55 plus the premium, $56.75. Bingo. That's the math. So we've got 300 in the stock, and if the stock, let's say the stock goes to 60, all right, we're maxed out, but it's the strike plus the premium, 55 plus the $1.75. In essence, our stock sale price minus commission is $56.75. And so, as Dan said, if you can do this, and covered calls, really most strategies, it's part of defining your approach to investment. If you're going to use options, I think you want to use them in a consistent way. You don't just pull a covered call typically out of the sky, do it, and forget about it. But optimum returns are repetition of whatever strategy you decide on, this being the income strategy. But you find your tools, you look at your annualized return. It's not to say that you do this one quarter And maybe the following quarter, that 175 may turn out to be $1.25. It may turn out to be $2.25. You know, those premiums change. Again, that's why I like the option market so much. There's a lot going on. Question?
If I buy a spread for 28 days and I'm going wrong in second week and I want to get out of it, so
How to
get out?
So the question is, and you're talking about spreads, yes, or relation to the covered call?
Covered call.
Okay, so in the covered call, we know, you know, our risk is, it's not to the upside, the risk is to the downside. Great question. You know, we put this thing on because we thought the stock was going to be stable, maybe go up a little bit. Something happens. You know, the stock takes off, and this gentleman says, darn, this is not, you know, this is not why I put the strategy on. Maybe you had, you know, a level of the stock where if it traded below, you say, I'm out. So you can turn around and offer that strategy to your broker, sell the stock, buy the call, you're out. Okay, so you can close out that position. Another thing you can do, which Dan touched on a little bit, this example of the stock, we've sold that out of the money call, right, the 55. Stock turns and goes down, you've got a 50 strike, you've got a 45 strike, you can turn around, roll down to a lower strike, which is, Dan, you went through that one example, you gained, I think, $2 more of additional downside. It really depends on what strike. But you can go to your broker and offer those types of trades, and they can get them done for you. But good question. And that's about the position management. I mean, it's not just options. All our investments, you know, take management, and that's one approach to the covered call. Rolling up or down as your opinion changes. So that's covered call. That's foundation number one for the collar strategy. We're generating income, but our risk is big time to the downside, below the premium we've taken in for the call we've sold. Protective puts. What do you think might be different about the protective put versus the covered call? You're limiting your risk to the downside. Completely agree. That's one real benefit. What might be, well, a reality and a significant difference to the covered call when you talk about a protective put? Well, but I'm not talking in terms of the collar. You know, when we talk spreads, we talk debits and credits. When we talk covered calls, that would be the credit side, right? Because we're generating income. How about the protective puts? Debit, bingo. And you do limit your downside, but guess what? You're now buying. You're paying for protection. Big difference. All right? Covered call, income generation. Protective put, love the downside protection, but I got to pay for the insurance. It's like our car, our homeowners, what have you. All right? Key difference, core concept. Protective puts, let's get into it a little bit. As this gentleman pointed out, exactly right, it establishes a floor for your downside. What does a put, a long put, represent? If I buy a put, I have the right to do what to the underlying? Sell it, bingo. All right, so that's why you've got a floor. You buy a put, you have the right to sell the stock at that strike price. That's the protective put. You've put in a floor, you know, in essence, an insurance policy, but it costs money. I mean, you know, at the OIC, we don't only, you know, just talk to retail investors. We talk to lots of financial advisors. We talk to lots of folks, you know, in the institutional space, the pension plans, endowments, foundations. They're always talking about protection, 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 you know, for these multi-billion-dollar portfolios. Well, protection's great. The reality is, especially in a low interest rate environment, where are you getting your returns? So, the balance of, can I afford protection? What's the most cost-efficient way to get protection is an important question.
Joe, one question came in.
Yeah.
Guys, maybe we can
Okay.
take it along the theme of what you've got.
If I sell an in-the-money covered call, won't it be exercised immediately? Okay, so let's start with that. If I sell an in-the-money, because it's a two-part question. If I sell an in-the-money call, will it be exercised immediately? Not if there's time premium. Does that make sense? Yes. Two parts to an option price. If you're in the money, you've got the intrinsic portion, right? $50 stock, $40 call, $10 in the money amount. Agreed? That's the intrinsic part. Let's say the option's trading for $12, $2 a time premium, okay? If you own that option and you exercise and the stock's at 50, you get $10, right? You get the stock basically at 50. But if the option's trading at 12 and you exercise, you gave up $200. That's the reality. That's why, great answer, it's the right answer, in the money calls may, if the stock's 50 and we're talking a 40 call and the option's trading at $10, to this gentleman's point, with no time premium, you can expect to be assigned at any time. But most options have some time premium. So just to answer the question, if you sell an in-the-money call, if there's time premium, it is highly unlikely that you will get assigned. 23 years on the floor, I would say maybe 10 times or less I got assigned when I shouldn't have. It happens, but it's very unusual.
How much time premium would you say?
Well, a gentleman's following up. How much time premium is enough not to exercise? Well, to me, any amount of time premium. Because if I'm long that option, I want the maximum value for that option if I'm selling it. If there's time value, I'm exercising the option that has intrinsic value and time value. I'm not exercising. Let me get to the second part, and I will have to transfer the stock to the call buyer. And I'll have to well, as far as the transfer of the stock, I'm not sure that relates. But the point is, and it's a very good question. Thank you online. In the money options, in the money definitely have intrinsic value. At the monies are all time premium. Out of the monies are all time premium. So in the monies, have intrinsic value, and most of them have time value. So chances are you won't be assigned right away. And taking it a step further, let's think common sense now. If you decided to, I did say in the covered call, you could sell an in-the-money call. Well, there's no way, I don't think, you're going to sell an in-the-money call if it's trading, if it's only, if the intrinsic value is the same as the stock, $40 stock, or $50 stock, $40 call is $10. If it's trading for 10 and there's no time premium, if you do a covered call, it makes no sense. You're going to, the point of the covered call is to generate income. So you're going to definitely sell an in-the-money with time premium. So aside from the outlier of a dividend, you don't have to worry about it, being assigned. So, but good question. Let's go with a protective put example, and then I'll turn it over to Dan. XYZ trading at $65. Investors bullish on the stock, and fortunately, long from $60. And as you'll see, the collar, which we're going to roll into, most often applies to stock positions that already have profits built in. That's typically when you implement a collar strategy. So the investor buys a 3-month 60-strike put for $1. Stock's 65. We were lucky enough to buy it at 60. It's run up almost 10%. Now we're a little nervous. We want to buy some downside protection. And as this gentleman pointed out, right-hand column, bottom right, you can see that stock, which we bought at 60, went to 65, and then turned and headed south because we put in a floor of the stock at $60. We've only lost, the amount of premium we paid for that option. Okay? So that's the point of protective puts, buying your downside protection. Does it make sense?
Yes.
Question is, as always, what strike? Remember that one slide I had up in the second presentation? We had strikes from 80 to 100, all kinds of different months. When you pull up your platforms, you've got such a variety of strikes. That's why I think, getting a good sense for what bullish strategies, what bearish strategies, what neutral strategies make sense for you is a great discipline to develop, because chances are it will help you to find different strike prices. So that's the protective put. Here's how it looks. The thing about the protective put, and notice the right side of this chart, very different from the covered call. Covered call, we cap our upside by taking on the obligation to sell the stock at the strike by selling the call. The protective put gives us a floor to the downside. That's why we go in a horizontal here. We're stopped out to the downside. But if your fear of the downside happens to be misplaced, stock turns and takes off, look at what happens. You've got unlimited upside potential minus the premium you paid for the put. So a question that I have always, as long as I've been in the business, I've always thought it's almost a trick question. You do a protective put. Is it a bullish or bearish strategy? What do you think? We know the motivation is downside protection, but is it bullish or bearish? You would think it's bearish, but it's got unlimited upside profit potential. So just, it's part of the interesting aspects of the option product. There are different benefits and risks to the combination of stock, long options, short options, and I think, that's one of them. So Dan, how about you want to bring this baby together?
You're a hard act to follow, Joe. Okay,
Here
so
we
we're
are.
on Broadway, right?
Yes. No singing, please.
I have very good news for you. I don't sing or dance. But I have a story that might be of interest. So I mentioned earlier on that the NASDAQ market site is just 2 blocks from here.
Yes.
And that's where we open and close the markets each day. Let me get rid of this, excuse me. But we run all the NASDAQ markets from Philadelphia. And for everyone that sits in this room, everyone knows everything that happened in this country started in Philadelphia, right? So does anybody here know how trading began? That's the usual response I get, kind of like a Stonewall response. How did trading begin? So the earliest ruminations of trading date back to 1753. There was a guy by the name of William Bradford. He had a newspaper in Philadelphia, and he was in competition with another guy named Ben Franklin. So you're in the newspaper business. What do you need to sell newspapers? You need content, right? So the story of the day was financial transactions. How to get to be the first one to put in the newspaper. Here's what real estate sold for. Here's what this sold for, that sold for. So William Bradford had an idea. He said, I'm going to make a club of businessmen. I'm going to charge them each year to come together. And we're going to hold it in this place. And on this door it says London Coffee House. So we're going to call it London Coffee House. So each day group of businessmen would come together, they'd make their own transactions. And they would make transactions in the earliest securities in this country. Would anybody care to guess what some of the earliest items were that traded? Any ideas? Go ahead. That's not bad. What? That's a great choice. Yeah. Wheat's good. All, no, so good. No, all good on the table. Coffee. Coffee, the first item that was traded. London Coffee House. But also the first security was the purchase of ships to go and source commodities like sugar, like cotton, like wheat, and bring it back. Could invest in the ship, because what's going to happen with the ship? It had risk, could sink or go under. So that's 1753. That goes on for a little less than 40 years. And then something comes along, the American Revolution, right? Then something else comes along, a big war. Now the government has a problem. They got to get money. They finance the war. They start selling bonds. And the bonds are a disaster. Everybody who buys the bonds goes, the government, too much debt, not enough income, insecurity, will it survive? So there's a financial crisis in 1789, and there's a great American patriot by the name of Robert Morris. Maybe people have heard the name. He comes up with an idea to Congress. I am going to go to the marketplace and say we're going to replace all the old debt with new debt. And the new debt, we're going to call it new debt, and it'll be good debt instead of the old debt. Because you see, the old debt had sunk from a price of 100 cents on the dollar to 15 cents on the dollar. Bad, right? He goes to Congress in the fall of 1789 with this crazy hair-schemed idea, and guess what? Congress says, go for it. They do the bond refund, the debt refund. Guess what the new debt trades at? Perfect, 100 cents on the dollar. This is great. The republic is saved. There is confidence in the American government. But then there's another problem. The only type of trading was between you folks, one-on-one. And it took place in a bar. Still, it's called City Tavern, it's still there. And the problem is, you might be a nice person and offer to buy from you, sir. But if they give you the money today, what happens if you don't show up tomorrow? Yeah. And hence was the motivation for the birthplace of trading on April 5th, 1790, for the trading of United States Treasury bonds. That was the first product that traded on an exchange, and stocks weren't until a number of years later. So all of us here today date back to one common denominator, the debt of the government. I guess you could say some things change, some things stay the same, right? So in terms of picking up where you left off, the options collar strategy affords a lot of opportunity, but it also affords a lot of questions. And as Joe went through extensively, it comes together with two strategies. On the upside, it's a covered call, because you own the underlying asset and you've sold a call on the upside. Sorry. But at the same time, you're looking to have a protected put in place. So I'd like to just start out, because a question came in from online, and thank you for the question, which really sets up the theme of this presentation is, how far out of an expiration do you choose that call and that put? And will those call and puts have the same expiration? These are all decisions only you can make. But in terms of a collar strategy, ideally, the expiration date you'll choose will be the same for the call and for the put. So in terms of the strategy, let's go on and take a look at it. Joe went through a very clear description of what a protective put is in terms of the downside. The irony is whether you call it a bullish or bearish strategy. Very hard to do, right? Certainly. But at the end of the day, it is a strategy that's easy to comprehend. All of you buy car insurance, ideally. You know what you're buying out of your pocket to buy insurance for a downside movement on the stock. And unlike the short call that you will sell, with that put, you have the right, but not the obligation if you ever need to put the stock at a time of exercise. So the question really becomes, why use a collar? And I like to look at myself in the mirror and go, hey, you're getting to be with a little more gray hair. You've worked in the workforce for a long time. You have friends of relative age. They might have been in companies where they got stock. They might be sitting on a bunch of one stock that is the company for which they work. So you actually have risk. You've got risk in that stock that you work for. So what is the ideal situation in terms of decision making when you're looking at going on to a second career or you're looking to retire? How do you manage what we call single name risk? That is the risk of your core holding. Well, a collar is ideal for managing single name concentrated risk in any portfolio. And it doesn't matter if it happens to be a stock of a company. Maybe you worked for the telephone company for 40 years, AT&T. You have AT&T stock. Or maybe you've been an astute investor over the years and you've acquired a number of shares of an actual ETF. Again, it doesn't matter what the asset is. It only matters, do you have risk that you are concerned about having a severe washout? So can anybody think of any severe washouts in the ETF market, a recent note? There's about, you said 2,000 ETFs out there, Joe? Save you the suspense, we had really an interesting washout with the country of Turkey, the Turkey ETF, dropping almost 50% in just a couple of trading days. This is a risk that comes to any asset that we have, but you might have a big concentration in the Turkey ETF. So it's not unusual to see movements of risk greater than the standard deviation of the stock market each day of 1.5%. Could be an event risk of 50%. And that's where the collar comes in to being a great, useful item. But I don't know how you spend your Saturdays. I usually spend mine running errands, going to the store. And I'm a pretty thrifty shopper. I like to find what's on sale. I'm always looking to find the best deal. That's just the way I like to shop. I trust everyone here values their money, and that's important to them, is to find ways to save. Well, it's the same concept here in a collar, is that you now, in terms of the trade setup, can find that hedging strategy at perhaps the lowest cost. That's one of the nice attributes, and that is simply achieved by taking the money that you receive in from the short call that you sell, ideally above the asset price, and using it to finance purchasing the put on the downside. Everybody likes zero, right? I like to buy things for zero. This is probably the one strategy that will get you to a zero-cost strategy. But at the same time, it doesn't eliminate 100% of your risk because, like the question asks, what time do I put in for these collars? How far out? You're going to also have to figure out the question, how do I choose the strike levels of where I sell the call or buy the put? These will all have a definitive effect on the outcome of the trade and, of course, out of the money pocket. Will it be free? Maybe not. You're still going to have to pay brokerage commissions, that's for sure. And I listen with great interest to your question in terms of, hey, I've got multiple legs now. I'm now concerned about important things, bid-ask spreads. Well, in terms of this strategy, the good news is that your broker will position it together as one trading opportunity. So market makers are not going to look at this and go, hey, here's my bid-ask for this call on the upside. Here's my bid-ask for the put on this. They're going to put them together and say, here's a bid-ask for the package. And normally that will be less than the composite bid-ask of the separate legs. And that's the real upside to you as a retail investor utilizing the options markets. Putting together strategies allows you to get efficiencies in terms of the strategy. So in terms of the key benefits, we've gone through, in terms of the cost, very low out-of-pocket. And now you've got to look at your objective in terms of time. But keep in mind, you still have that long stock position. You're going to have to do something with it today, tomorrow, and next week. And you're going to have to do something with it at expiration if it's not been called away. So let's go ahead and take a look at a theoretical stock. We're still trading XYZ, Joe, is that correct? That's the favorite stock of OIC? It's a winner year after year? I like how it's gone from $52 to $75 an example, so it's guaranteed investment return. So here's an example where you have a stock that's gone over time from $52 to $75. A great move. And the gentleman in the front row here showed me one of his stocks that he's following has had a similar move, a big upside. And he asked me the question, what are some of the strategies that I could use? Well, a collar might be perfectly suited for a situation where you've had a big move to the upside, and now you're like, I do not want to give back 50% of the gains. And I will part with it and pay the tax man my gain on the upside. So one of the easiest ways to choose a collar is to take the real simple figure of 10% in terms of, hey, where's the stock going to go? Collars should only be put on if you're going to look for a move of 10% or greater. Anything less than that, you're probably wasting your time. Of course, you're free to choose as you wish. You may feel that collars can be used in the shorter-term situations. You might feel to be event risk, like earnings coming out. We're in the midst of earnings seasons right now. But generally, from a retail perspective, in order to hedge a larger single-name risk, 10% is a great bogey. But as Joe said, there's a million strikes in the business. Here on the screen, what do we have here? 35 bid-ask right here for 7 strikes. So there are a great number of choices that have to be looked at. But there's one very easy way to put this into perspective. And that's simply here by focusing on the 2 red dotted boxes. So we talked about a stock price at $75 with a 10% move. So now we're going to look at where we might find our downside protection. And in the middle, I think I'll try it with, in the middle of the screen at 67.50, it's a little too far on that side. That is our lowest downside strike that we're looking at for protection. We look at the bid ask on that put, and we see that it's 57 cents bid at 67 cents. In other words, if you're going to buy that put right now, you're going to have to pay 67 cents out of your pocket or $67. Of course, as a trader, as an investor, you can always split the bid ask. See if the market maker is interested. Nothing obligates you to pay that ask. You might be very interested in it and show a bid 2 cents below to see if you can get a better price. That's what I'm talking about buying things on sale. Ensure that the bid that you place in the market matches your interest level for purchase. And also, look to pay less than the offer. Always look to pay a price that I like to call on sale. Simple. Less money out of your pocket to buy that position.
Would you say that a good strategy would be to put in your bid in the middle between the bid and the ask?
So the question is, would it be a good strategy to place a bid in between the middle of the bid ask? And the answer is yes. And before, the gentleman over here talked about what is fair value. Fair value is generally that midpoint in between the bid ask. That's one easy way to assign fair value. So now, the decision is, okay, you didn't get hit on your bid, but you're in the middle of the bid ask. You can now adjust that order, increase it by 1 penny or 2 pennies. You'll find right away the interest level to sell it to you, because now you're starting to pay slightly above fair value. You will attract interest. So thank you for that question.
I got a question.
Yes, sir.
Let's say, like he made a lot of money in his position.
Right?
I'm gonna buy what you call a long put, long term,
Right?
3-4 months out.
Mm-hmm.
And I'm only looking to make 2%
Mm-hmm.
a month. If I can maintain it for a year and make 24% of my money, is that a good strategy?
You're asking a strategy, you're long a stock, and you want to buy a longer term put, correct?
Yes.
So that's a function of whether it's going to be an in the money, at the money, or out of the money put. Cost out of your pocket. And it will also depend over time how the stock moves. So stock moves lower, you'll be a winner. Stock moves higher, you're going to lose premium in terms of the raw price change, but you're also going to lose time decay, something Joe talked about, the extrinsic value, the time value of that option. So you lose in 2 ways as you march forward in time and as the stock goes higher. So is it a good strategy? It's a decision of how much insurance you want to hold at any time.
I'm gonna send my call every month, month by month. But my put is way out.
Yeah, so you're basically talking about doing a collar where you have short-term calls, but you're buying a long-term put.
Right.
So in that case, it's going to cost you money because you're going to pay for the time value of that put. So would it be a good strategy? It depends on something that has nothing to do with this presentation and how I like to look at things. Can you sleep at night with that decision? Because it's your money. That's the key decision.
And the only thing I would add to that is, and it's a strategy where you're long that underlying. In essence, it's a time spread diagonal from a name perspective. You buy that long-term put. The key, and this gentleman talked about bringing in 2% per month. The key is the discipline to selling that call every month. Because obviously, on the insurance side, on the put side that's far out, maybe that long-term put costs $6. Maybe you have 8 or 9 months between the time you bought the put and call strike expirations. So you'd have to obviously sell more than $6 worth of that put premium over that period of 8 months to make that thing work. So it's all about the discipline of the repetition of selling the strike month after month.
Yeah. It's a very sophisticated question. Thank you. So in terms of the setup of the collar, the next item is to sell that call, the call that's just out of the money. So in this example, we're looking at a strike of $82.50, and the call premium, the bid, is 77 cents. So for ease of illustration, at the point here where you sell a call for 77 cents and you're purchasing a put for 67 cents, you get money in your pocket. You get 10 cents or $10. What can $10 buy you here in New York? Maybe coffee and something. So, and in terms of the zero-cost collar, this is your profit horizon. So again, nothing contravenes the fact that you're long 100 shares of stock. But your upside is capped by the call that you sell. In this case, it's at $82.50. So you ride that stock all the way up to $82.50, then you're done. All right? You were willing to give up upside on this strategy. But here's the great news. As this stock goes down, you are basically fully hedged. That is one of the best attributes here. But you're fully hedged to the extent that the puts kick in at $67.50. So you do have risk. Your risk is defined in terms of price between where you own the stock, which is 75, and the down put strike of 67.50. So I'll just take a quick break. Does that make sense in terms of the strategy? Please.
Instead of doing that strategy, can you go back to the next one?
Go this one?
Instead of doing a spread, if I sold the $8,
Or hold it, the 8 or the...
no, if I sold the 6, instead of buying the put, I
Right.
sold the call for $67.50. Now I have the same downside protection. I collect $8, right? So I'm making 50 cents on it instead of 10 cents. I have a 50-cent credit.
Yeah. You're talking about selling a deep in the money call, right?
It's the same as the protected put.
Yeah.
It's still at the same price.
I-
I'm protected to $67.50.
I hear you loud and clear.
But that's the insurance.
Yep.
You don't have the upside.
Yep.
You don't have the upside in the other one
Yep.
because you're only getting 10 cents. There's
But-
no upside.
The idea here in setting the 10% is so that you basically, the goal of a protective of a collar is that you're using it for insurance and that you're not going to have your stock called away. You know, that's you're trying to go into a range. You're pretending that it's not going to be a range. It's not going to be something where you're thinking the stock's going to go 2 or 3 times to the upside. Do you have
You do have the upside. You get 750 upside, not 10 cents. You have from 67, you have 67 and a half to 70. You have 75 to 82 and a half. So you have 750 upside, not 10 cents. So,
You're selling the call. That call is going to be exercised. So, yeah, you'll get that premium in at $67.50, but then add that to your strike. That's your proceeds. Yep. That's the end of the day. It's just $67.50 plus 8. We'll move forward. We can go through it afterwards and draw out the explanation. So we just went through where we are at expiration. And now look at the situation where the shares are below 67.50. We just talked about in terms of what our maximum loss is on this position. We assumed you're long the stock at $75. And you decided now the stock has really tanked. Let's say it's gone to 20. You're selling those shares. You call up your broker and say, exercise my put. I want to sell them at my strike price, which is $67.50. Therefore, now you've suffered an open market loss between $75 and $67.50. And you have a slight credit from the initial transaction of 10 cents. So your maximum loss is $7.40. So if you go back to the initial premise, you're long a stock at $75, this strategy gives you basically a 10% protective collar. Hence the design. Does that make sense in terms of the setup? Why don't we go through here? But how about if it goes in between? You bought a put on the downside, you sold a call on the upside. So will your long call get exercised if the price is less than $82.50? No. Do you have any motivation to exercise your put if the stock is above $67.50? So the other concept of a zero collar strategy is what we call no harm, no foul. You got exactly what you want. You got insurance on your position. You got a little bit of a credit. Hopefully it took out some of your brokerage commissions, but nothing happened. You didn't have a taxable gain. You don't have a loss. No need to pay the tax man. And you still get to maintain that stock position. On the assumption the stock pays dividends, you have the benefit of continually collecting that dividend. And unlike the a covered call strategy that we put on earlier, which was very close to the strike, given that this call is out of the money, you will not have the apparent risk of having early exercise on the day before ex-dividend date. It's too far away. So I like to say, as though as unimpressive as it sounds, you can keep your collar and eat it too. That is, keep your dividends. And I think we've just gotten through in terms of where we are on the upside. The nice part here is that if you're going to have a loss of about 10% on the downside, what's going to be your gain? Of course, it's going to be a 10% gain on the upside. Buying that stock at $75, if it's gone above $82.50, your stock's getting called away. But the good news is that you have a taxable gain. It did exactly what you wanted it to do. You made the decision to enter into a contract to deliver that stock to a buyer in return for financing the downside put. So $7.60, 10% gain. Maybe you're saying, look, I've been in this stock all my life. I'll take another 10% to the upside, sell it, and now I'll figure out what to do with the proceeds thereafter. Maybe diversification. Go into a basket of stocks. Go into different asset classes like commodities or currencies. So it's important to kind of put everything together in terms of a wrap-up phase and look at this from a perspective of what happens if the stock plummets. You, again, have the protection to your downside put. But you've got to make some decisions. Where is it in relation to that downside put come expiration? Is it severely below? Is it right along there? And just as we talked at repairing a covered call strategy, nothing prevents you from repairing a protected put strategy in this case. The focus now being on a stock plummeting. What do I do? Do I keep my put? Do I say, look, I'm going to exercise? Or do I go, I just don't want to sell the stock. I've been with it for 40 years. I want to keep it. You could definitely roll that long put. You could roll it down. You could sell the current $67.50 put and buy a lower strike put. Maybe it's $60. Of course, this will take money out of your pocket, but it gives you a chance to frame the trade in your eyes. And what happens if the stock remains flat? We just mentioned. You can do this again, rinse and repeat. So the gentleman down here talked about what if we bought longer term protection and sold shorter dated calls. This is what Joe went into in terms of great strategy, but it requires you now to be what I like to call Johnny on the option spot. You need to be cognizant of every single monthly expirations. So if you decide to have a long-term protection, you're going to need to focus on that each month. Maybe if you have a strategy where you have mixed up a little bit, maybe you sell a long-dated call and buy short-term puts. Maybe you do the reverse, buy long-term puts, sell short-dated calls. All of these are decisions that only you can manage, but they require your ever-present attention because it's important to remember that no matter what you do with options, you have the god of theta smiling at you every day. And what is the God of theta? Exactly. And time decay is your friend when you sell an option, but the God of theta is your enemy when you buy an option. Every day you go forward, there's less time to that expiration, and the amount of the extrinsic value or the time value in the option will decrease. So that's an important consideration when you mix up the collar to go long-term and short-term. Whoops, excuse me. So at this point, we're going to bring to a close, but see if there's any last-minute questions for Joe or myself, because we've really thrown a lot of strategies today. First, going into the covered call. In terms of now we've kind of finished up with, hey, covered call, protected put, iron condors. I mean, there's a lot of information here. So probably the best path in terms of follow-up would be optionseducation.org.
Great idea. I mean, all kinds of things, as we mentioned. Events like this, podcasts, webinars. We're doing a couple webinars, a month for sure. And one thing I didn't mention, I think it might be on the slides. Oh, there it is, My Path. You may or may not be aware of the My Path. It's right on the website. It's a 20-question assessment. It's absolutely dynamite. Like everything, funded by the industry. But you take a 20-question test. We'll rate you beginner, intermediate, advanced. And with that, we download lessons for you at the appropriate level. You take them online anytime you want. So that's My Path. I would urge you to, it just helps you build that base of knowledge. So.
You get that from the Options Education Board.
Yeah, at optionseducation.org. That's right. And again, any feedback on the new website, greatly appreciated either in person here or online, in the drop-down box. So
from the birthplace of trading in 1790 to today, options trading, what we say is the markets are here. They serve the investing public. We're here to help you with your educational outreach. Thank you to everyone.
Yeah, thanks, everybody.
Have a great rest of the weekend. Thank you.
This was awesome.